Hey, good afternoon. Happy Thursday. How's everybody doing today? So, we have a beautiful day here in Chicago. So, for those of you who don't know, I live in the Chicago area, about 40 miles west of Chicago. It's funny because I was on a call with a prospective client today, and I always introduce myself as being from Chicago because I live in St. Charles, Illinois, and nobody really knows where nobody knows where St. Charles is. I figure, so I just introduced myself as being from Chicago, and she asked me, she's like, "Well, we're in Chicago," and I tell her, she's like, "I know somebody lives there," and it was funny because it's like the fourth call in probably the last 6 weeks where when somebody found out I was from St. Charles. They knew somebody here, or they knew somebody in one of the surrounding towns that we live in. So it's a small world. So, welcome today. Hope everybody's having a great week. Um, for those who don't know me, I will introduce myself again. My name is Carla Modes. I am a fractional CFO, a profit strategist, and a business coach. I help female entrepreneurs get their financial shit together so that they can focus on their zone of genius and uplevel their business. A lot of my clients that come to me have had, let's call them neglected financial processes. They're making money, and they built a really nice business, but they focused on the front end of their business, and their financials have been kind of pushed aside. And I help them get all that straightened out so that they can go focus on the things that they do well and really build their business and take it to the next level. I've spent 30 years in corporate finance, accounting, consulting, and did my obligatory stint in public accounting, including during that time in corporate. I managed an invoicing group that processed 18,000 invoices a month and 15,000 payments a month. And I throw that out there because we are talking to this week about ways you can improve your cash collections, get the cash in the door faster. And so I just throw that out there because, I have managed a group, and, I know what I'm talking about. And what I'm bringing into this are some of the things I've seen that we did there, as well as obviously we're doing things on a lot larger scale than most of you are. But one of the things that I like to bring to my clients is best practices. And there's a lot of things you can do in a small company or in a large company that you can also do in a small company. Just because it was done in a large company doesn't mean it can't be done in a small company. And so one of the things I like to do is bring some best practices from those, from my experience, from my 30 years of experience, and help you apply it in your small business. What we're going to do, this is basically the second of a three-part series where I've been talking about, how to speed up your cash collections. The other day we talked about best practices for invoicing, ways that you can streamline your invoicing process. And once this live posts, I will go into the comments and I will drop a link to part one. And part two today is we're going to talk about ways you can expedite client payments. And then tomorrow I'm planning on coming in and doing part three, where we are going to talk about AR management. So the first part was invoicing. I said you can't collect what you haven't built. So we talked about, best practices for how to invoice. Today we're going to talk about, okay, once I've invoiced, what are ways that I can, incent or things that I can control that maybe will influence clients to pay me earlier. And then tomorrow we're going to talk about, now that it's out there, what do I need to do? What are best practices? What processes should I have in place to handle monitoring and actually ultimately getting clients to pay us? So I post, one of the stories that I have is, so I had a client once, and they were really struggling. Um, they were struggling with cash flow, but really they were struggling with AR. They had a goal for AR to be about past due AR to be about 150,000. They had a lot of um, Fortune 50, Fortune 500 clients, and Fortune 500 clients. A lot of times, because they're so big, they basically say, "These are my terms. This is what I'll pay you. Deal with it." If you want to do business with them, you just have to learn to manage around that. And so they always had some past due AR, but they had a goal that their past due AR should be 150,000. And they were about a $20 million a year company, and it was $400,000. So if you do the math, it's 167% higher than it should be. And we were talking to the controller, and the controller is like, "I don't know what you want me to do, folks. I don't write the checks at the clients. There's really nothing I can do to influence AR. So what I want you to do is not be that controller. I want you to focus on what you can control, because yes, you cannot go out to the client and actually get them to write you a check or push a button for them to process the payment. But there is so much you can do, so much that is in your control. And so what I really want the whole point of this series really is to focus on the things that you can control. And what we're going to talk about today is offering early, ways that you can, like incent or set up your environment so that the client is paying you earlier. So first one we're going to talk about is offer early payment discounts. So a standard terms that you will typically see, or that you may offer yourself, I would say net 30 is very common. Some companies will do net 10 or net 15, but I would say net 30 is pretty common. Some clients, if you're dealing particularly like with these Fortune clients, these Fortune 500 clients, like I talked about earlier, they're like your big guy. And even if you're a $10, $20 million a year company, you're probably still a small fish in their big sea, and they basically can often dictate the terms. And they say this, I pay. It's not unusual for a Fortune 500 company to actually say, my standard thing is I pay invoices in 90 days, and then you get to decide, am I going to do business with them or not? But generally speaking, net 30 is a pretty common one. So what you can do is you can have discount payment terms. And so you could basically say, okay, my normal terms are net 30, but if you pay me in, say, 10 days, you get a 2% discount. Okay. How do you write this term? The syntax for it is like 2/10 net 30. But it's basically a sign to the client, hey, if you pay me quickly, I'm going to give you a little discount. And one thing to note is this, because when I mention this to clients, a lot of times I get a lot of, I don't want to take 2% off my revenue numbers. You don't have to offer this to every single customer. It can be a good option in a couple of different scenarios. It can be something, if you have somebody who's a slow payer, you can go out, maybe you're having trouble getting them to pay. Maybe you can say, listen, if you start paying me, in 10 days, you get a 2% discount. And, your client's accountant can do their own math, but it basically, that can add up to savings for them. And of course, it ends up being, yes, you're taking 2% off. Again, you don't have to offer to all your customers. It can be something you selectively use, but you have to basically weigh that 2% discount that you're offering against the value of getting the cash earlier. And in many cases, that 2% discount, can be negated by, the benefit of getting your cash in earlier. The one warning I'll have on these is sometimes these can be abused. You'll put on the invoice net 30, 210 net 30, and the client will pay you at 20, 30 days, maybe even 45 days, and they'll still take the discount. And you just can't allow that. You need to have processes in place. You need to make it very clear to the clients. So you definitely have to have a monitoring process in place. But it's definitely something to keep in your back pocket as a possible option. When I have clients that want to do this, one of the things I can do is I will model out various scenarios. We might look at, maybe a particular segment of clients. We can look at, are we going to offer it only to people who are past due? Are we going to offer it to everybody? Are we only going to offer it to, maybe we want to go out to these Fortune clients, these big clients, and see if they have if they'd be interested in something like that. So you can definitely do some financial modeling so you can see, if I offer this, so I can see ahead of time, if I offer this discount, what will be the financial impact to my numbers, to both my revenue and my profit, if I do this. So that's one option. Another option we're going to talk about is electronic payments. And electronic payments have become, so much more mainstream. I know when I worked in, so one of my jobs is I worked for ADP, the big payroll company. I actually worked for their car dealership division. That was so it was one of their divisions. I didn't work for the payroll part of the company. I worked for a company for the division that sold what we call dealer management systems, basically computer management systems into car dealerships. And our clients were, for the most part, didn't use credit cards but we would occasionally have clients who would ask for her and we wouldn't do credit cards. This was a number of years ago. Credit cards have become so much more mainstream, and a lot of it depends on your type of client. So if your client, again, if your client is General Electric, they're not gonna be paying you their bills on a credit card. But if if your typical client is a client like you, a lot of my clients use credit cards. They use credit cards to accumulate points that they use for travel, or they use them for rewards, or some of them use them just to float some cash flow. Okay, I can buy this month and not have to pay it off until next month. Unfortunately, some of them also use it for what I consider a very high interest line of credit. But if your clients are like you, a lot of them probably do want to pay on a credit card. And so you have yes, there is a fee. It's generally about 3% fee, but you have to weigh that. Just like everything else, there's cost and a benefit. You can weigh the cost of that up against getting the money in quicker. Because it could be, your clients, one of the reasons they're paying you slow can be that they have their own cash flow problems, and a credit card gives them an option. Okay, I'll go ahead and pay this charge now, accumulate the points, whatever. And, maybe they're paying it off the next month. Maybe they're carrying the balance for 5, 6, 7 months, whatever. But you're getting the money in earlier. The other thing is you can build that 3% fee just into your pricing. My point of view right now is that electronic processing fees, they're really just a cost of doing business, and you need to account for them in pricing. They're basically just a part of your overhead. Usually, merchant fees will show up down in your what we call the SG&A section, sales general administrative expenses. Is usually looking at other operating expense and miscellaneous expense. And when you're pricing things, you need to make sure that all of those expenses are properly buried in like an overhead burden rate. So I look at it as a cost of doing business, especially if your client has a demographic that wants to use credit cards. An option to credit cards, though, is ACH. Most of my clients are on QBO. That's what I use. QBO, it used to be that you could use ACHs for free. And if you dig around, there may be some places you can do it now, but a lot of your banks now are charging a minimal processing fee. And I know through QBO payments, at least at the time I'm recording this, there was a percentage up to a max of $10 per payment. So if you think about it, if you have a $10,000 payment coming in, you're paying $10 for ACH. It's 0.1%. I don't know about you, but that's a cost I take every day of the week. If I can get a client to pay me on an ACH, because what you're doing with this is how many times have you called a client about a delinquent account, and they said, check's in the mail. I'm putting the check in the mail, and there's a reason we call it snail mail. All right. So by offering credit cards, ACH credit cards, you're basically taking that away, and you're giving them away to get you payment in a much quicker manner. Another thing you can look at is direct debit. Direct debit's another option. You can even offer an incentive to sign up for direct debit. I do we do direct debit. You think about a lot of us will do it for our cell phone, our streaming services. They don't ask us for permission every month. All right, we sign up for the service. This especially works if you have a standing fee. So if you're a professional services firm, anything where you have like a standing fee, maintenance fee. If you are in a service business, a good example is I have a couple of home maintenance service contracts. I think I pay service experts to come in and tune up my furnace and air conditioner twice a year, and I rent water softener. It's in my basement. Very first time I did it, they made me sign up for direct debit, and every month they don't have to chase those dollars. It just comes directly out of my account. And sometimes I've seen companies go out and there's such a better improvement to their AR that people will often offer a discount. I had somebody, I think it was something I'd signed up for new, that said, if you sign up for direct debit, I think it was a cell phone. I think not too long ago, originally I was paying my cell phone every month. And then I got an email that said, if you sign up for direct debit, you get a one-time $30 credit on your next bill. Hey, sign up for that. So again, what you're doing here is you're trying to affect and control the things you can control and give your clients incentives for paying you earlier. All right. So the third item we're going to talk about is let's move if you can to upfront payments. And you can implement deposits or upfront payments. And this is especially good if you incur out-of-pocket costs. If you are a professional services firm where you're paying people to say you're a consulting firm and you're paying people, but you don't. Maybe you didn't take my advice in the last video and you only invoice once a month, but you're paying people to do work, and you're not paying your employees once a month. Probably you're probably paying your employees at least biweekly, and you've got to pay for that payroll. Take an upfront deposit. I worked at a professional service firm, and this is what they did for a lot of their clients. They required, I think it was a 10% upfront fee, and it basically funded their payroll costs for the first few weeks of an engagement. Again, like a lot of this stuff, it doesn't have to apply to every single client. You just want to have processes in place because you don't want to have a ton of one-off stuff. But especially if you're just trying to experiment on things, on some of these things, pilot them with a group of clients. Deposits or upfront payments can work really well with brand new clients where you don't know what their payment history is. Maybe you do a credit check. Maybe you don't. A lot of small businesses don't do that. It is a good habit to have, but it could be something where you require an upfront deposit until you get proof that they are, a reliable payer, and then maybe you don't do it any longer. But you need to consider industry standards and type of client. I'm not saying this will apply, that this is something everybody can use. It's very common, obviously, in bookkeeping businesses, professional service businesses, consulting firms. Upfront payments are pretty normal, sometimes it's called a retainer. It may not be as common maybe in the construction industry. So look at your industry, and also look at the type of clients you have. If I'm signing up General Electric, I'm probably not going to have as much ability to go out to General Electric and say, I need $100,000 upfront deposit. But if I'm working with a client that's smaller and I'm doing a really big job for them, I don't want to get to the end of the job and then not get paid. So again, it's minimizing your risk. It's bringing in money up front, that can help, basically fund out your working capital. And the difference between a deposit, I guess, and an upfront payment, when I worked in the software industry, it was common to have like an installation fee or an implementation fee, and then you had your regular monthly recurring. So again, you can play with this can even go into your pricing. You can play with different pricing models, but if you are doing, you're a consulting firm doing, software implementation, it's pretty common to have like an upfront fee that pays for the implementation, and then here's an ongoing monthly recurring that's paying for maintenance, so that's to me where a deposit is okay. I've given you a quote of something that's going to be $30,000, and to start the work I require a payment of 20% or $6,000 up front before I'll start any work. So those are a few things you can do. I hope these helped you. So again, offer some early payment discounts, embrace electronic payments, and then find ways that you can move payment to the front end of the job before you actually start the work. So I hope these all helped you. If you want more information, I actually just put together a free cash flow guide that you can pick up at the little banner that's scrolling across the bottom here, carlaboats.com/sign up with the dash between sign and up. And in this guide, I give you 10 ways you can improve your cash flow. And again, the whole thing is focus on what you can control. And then come back tomorrow. I'm going to do part 3 of this, and we are going to talk about one of my favorite topics, which is accounts receivable and collections. All right, you all have a great day.